If WIRP, you're looking at Fed funds futures, is pricing in the probability of a hike at this meeting at 16.1%. What's the Fed going to be talking about? What's at the top of their agenda when they're meeting today in Washington tomorrow?
Yeah, I think they're going to give an indication that as long as financial conditions are loose in December, they're going to raise interest rates by 0.25%. And as well, they're going to be somewhat more optimistic about 2017. But nonetheless, this meeting that they're having is just a setup for a December rate hike.
So no news conference tomorrow. We will get a statement. What are you going to be looking for in that? We talk about signaling. Are there things you're going to be keeping a particular eye out for?
Well, they'll talk about financial conditions. They'll also mention the unemployment rate as well as potentially the inflation rate. And they'll say that it's transitory and it's going to be moving back to 2%, which basically is a hint and a wink and a nod that, again, that December's on the table. As long as we don't see an unhinging of the financial system post-election, then I believe we're a go.
Okay, you think it's going to happen?
Yeah, absolutely. No, it's going to happen. With that said, though, we're not terribly hawkish, believing that the Federal Reserve is going to raise interest rates all that aggressively in 2017. We believe they're going to go one more time. And really, our terminal rate, which is off consensus, is that we think that 1.5% is their terminal rate.
As you play this out, what does it look like when they do, in fact, raise rates? How illustrative is it, for example, to go back to that December rate hike that they made, that one-and-done rate hike now more than a year ago? What does that teach us about what's going to happen this time around?
So what it's telling us is that the markets are not looking at the one rate hike, but they're looking in the outer years at the dot plot and where they're going to go in 2017 and beyond. And as they start to reduce that expectation on their Fed rate hike in 2018, you saw that the dollar started to react a little bit less aggressive as it did back the previous year. Hence the reason why we believe that the dollar will accrete in value, but it won't accrete in an aggressive fashion like it did back in last year. It will go about 3 to 5% higher over the course of the next 12 to 18 months.
When policymakers try to assess the health of the American consumer, you got GDP figures out a few days ago showing some weakness there, then consumer spending more recently than that, kind of countering that. So squaring all of that, how do they see the health of the consumer right now?
So I think the Federal Reserve is looking underneath the covers, and what they're looking at is mortgage debt, seeing that if mortgage debt is expanding at a normalized rate, we're still below or recessionary trends there, as well as they're looking at the average population of people that are working in relationship to the overall population. And what they're seeing there is that, you know, we're still well below where we need to be and that we still have a lot of work to do. And that's the reason why they're going to continue to say and hit the drum that they're going to be quite accommodative over the course of the next 12 to 18 months. They really don't want to unhinge the financial system. They just want to kind of take a little bit of the speculative fervor off.
You look at what's happening with the Fed, you look at the Bank of Japan here leaving its monetary policy unchanged but revising its inflation forecast here to after Governor Kuroda's term expires. And there's a sense, we were talking about this morning on Bloomberg Surveillance, that central banks are learning, that they're reflecting on what's happening, reflecting on the data, and making changes and adjustments. Is that a good thing for an investor to see a central bank moving nimbly, or do you want it to be moving with authority?
No, I want it to be moving in a nimble fashion. It's based off of several factors. One, money creation, economic activity. The Federal Reserve has to not only look inward at the United States, but the whole global economic system and the financial system. And they have to be somewhat more nimble from that perspective. Look, they're faced with a tough situation here. Global growth is decelerating. The main contributor of actual debt creation has been China. They're going to be pivoting. That investment spending from China is going to decelerate over the next 24 months, and they're acutely aware of that. Hence the reason, again, that they have to keep a careful eye not only in the United States on economic conditions as well as within the inflation trends, but also what's happening across the globe.